Okay, so before we get into tonight's main show topic for the live stream show, let's just go over the economic data that has come out, some of the key points in the last day or two for the U.S. economy. So first, the Fed's official balance sheet is down by about $15 billion, give or take, over the last week officially. Again, I don't really trust that because just look at the dollar, look at the money supply growth. So the official balance sheet says one thing, the weakness in the dollar index is now below 93. So it's bouncing around there in a bunch of different support levels in there before it might go down to 91 or 88. And if it breaks 88, it's going to be real trouble. I have a technical analysis chart behind the paywall for my over 1,000 now Patreon account contributors. If you want to sign up for only $5 a month, there is over 100 pieces of unique content, research, well-researched articles with fundamental analysis, technical analysis, audio podcasts on a lot of different topics behind the paywall if you want to take a look at the updated dollar index chart that I put out. But as of right now, there's still some support levels left on the dollar index, but we'll see if they hold or not. Okay, so in addition to the Fed's official balance sheet being down 15 billion, give or take, the Q2 GDP numbers for the US came out and they are the worst ever. They dropped by 32.9%, which is not the number that the Atlanta Fed was projecting, but guess what? The stock market didn't care. The stock market just shrugged it off. We have hedge fund managers like Keith McCullough of Hedgeye, well, former hedge fund manager. I don't know if he trades his own account. I'm not sure if he manages hedge fund money now. He focuses mostly on research and his own trading. And he interviewed this hedge fund manager named Michael Taylor, portfolio manager at Critical Mass Partners, and they were talking about, in a recent interview, about the plunge protection team. I'm not going to play the audio clip right now. Actually, you know what? I could go, let me just grab it really quick. I have it right here.
87. So we've had many instances of the Feds giving the wink nod.
What the hell's the PPT, and why do you keep talking about PPT at 2 to 3 in the morning?
Oh my God. Do you mean the Payment Protection Program? I'm sorry, did you say PPP or?
I found the clip, so we'll play it real quick. It's only a minute or two.
PPT, the Plunge Protection Team.
Oh my God, you believe in it. What are you talking about?
Do you believe in it? No, some people think that I'm being a conspiracy theorist. I mean, they think that I'm just making it up.
Actually, it's actually quite well documented throughout history. Many instances in 87. I mean, Art Cashin has gone on many times to recreate and replay that back, where the banks called the Fed and said, by the way, we have all this insurance, it's going to be bad, and then they said, why don't you start buying stocks now? And that was it. And that's going back to 87. So we've had many instances of the Feds giving the wink nod in order to move stocks. There's many ways to do it now, though, because they can do it through bonds, they can do it through selling vol. So they don't have to go and directly buy equity futures in order to move markets dramatically. And honestly, all they have to do is get somebody else to do it with a wink nod. And that can be, I mean, look at overnight repo, right? Overnight repo is a great way to do it because you're basically telling them, like, hi, we're going to give you a shit ton of liquidity. What are you going to do at 3 a.m.? That's it.
No, all you have to do is, and moreover, and in this day and age, you just have to get the machine who doesn't think at all to believe, and then they just chase the pattern. So, I mean, there's more, to me it appears that there's more than a collective effort from the buy side fully loaded, whether it's the quants or other people with an interesting agenda, to make that happen. It's an interesting setup. I mean, to me it's quite bubbly. I don't think you entirely disagree with that. There's a lot of behavior out there that is beyond bubbly. I mean, what do you think about that component of this into the setup? The whole notion that I think the one-liner is stocks don't go down.
Okay, so I played that clip for you guys. I'll attach the link in the information and description section if you want to listen to the whole interview. But the point is that a lot of people are openly discussing stock market and other manipulations now in public, that it used to not be polite conversation to discuss this. I remember when I was first getting started, there was very few. It was called fringe. It was considered fringe to discuss things like this openly. Now you have a lot of people openly discussing this on podcasts, more mainstream people discussing this. And this goes into my point about the real economy versus the asset markets and the stock market. So they're openly talking about market manipulation. You also have the jobless claims numbers, and another 1.416 million new Americans filed for unemployment. The total amount, once the crisis started, it's over 54 million Americans now have filed jobless claims. So it's an insane number. And again, this is divorced from asset markets. So the real economy is totally dislocated from asset markets, and a lot of it has to do with the Federal Reserve, and also we have an election coming up in the not too distant future. Okay, so let's get into tonight's main show topics about the oil market. I've been getting a lot of requests to do an oil market update, and honestly, the oil market has been kind of boring for the last 6 weeks, give or take. So the oil market it rallied pretty strongly, and for the last 6 weeks, it's been fairly range-bound in the high 30s, and it's peaked its head, I think, above maybe 41 very, very few times. But really since June 22nd, I looked back on the charts, June 22nd, June 23rd, when oil got above 40 for the first time in quite a few months, it hasn't really done very much. So it's a very calm market, but calm markets can tend to be the calm before the storm. And with a weak dollar, with what we're seeing, one would think that maybe a higher oil price would be in the cards, but I think the supply-demand fundamentals for the oil market and the articles that you can see there on your screen, a lot of experts are looking at this, whether this is, I think, Rystad Energy Research or Royal Dutch Shell. And then there's also the article here from Energy Intelligence. It was a free article from Thursday, July 3rd. Well, actually, that was their way. It says Thursday, July 30th on their website. The article is from Monday, July 27th. About oil price pattern sees rising selling pressure. The oil price has been extraordinarily stable over the past 6 weeks, but the stability could well be disguising a steep price fall in the making. Charts from technical analysts show the front-month Brent futures contract closed over $40 a barrel for the 30th straight trading day on Monday, and the U.S. West Texas Intermediate, or WTI, price made it to 12 consecutive trading days above $40 a barrel. The current slow price advance is interpreted as stability, Walter Zimmerman of ICAP Technical Analysis wrote in a note, but it in fact, quote, reveals powerful overhead selling pressure. In the report, Zimmerman says the WTI price is moving in a, quote, diagonal triangle wave, 5 up. Such a move is rare in technical analysis charts and only happens when prices have risen fast before. The WTI September contract rose 90% in 2 months. In the charts, the market has been rising, quote, too far, too fast, and the current waves of trading slightly up create patterns that are excellent bull traps. Quote, in a textbook perfect world, the September contract would bottom out by $40.20 a barrel, then rebound to $43.25 a barrel area final peak, then keel over and drop hard, ICAP said. The September contract, which expires on August 20th, hit a low of $40.48 a barrel on Monday. The lack of firmer uptrend has pushed numerous traders to the sidelines, with concerns growing about the global economy. Again, the concerns about the global economy go back to the fundamentals of oil for supply and demand, particularly the demand side, which are the story headlines you can see there on your screen. Oil prices were weak on Monday before recovering in the afternoon. In New York, the NYMEX September WTI contract closed 31 cents up at $41.60 a barrel in modest trading volume. In London on ICE futures, the Brent September contract added 7 cents at $43.41 a barrel in light trading volumes. The physical market signals that the immediate surplus of crude supply is ample, with the Brent contango where spot is a discount to later supplies at more than 30 cents per month per barrel, which pays for storage. West African oil producers have had trouble selling their September loading oil, and that is a key bellwether in the light and sweet crude oil market. Traders there note sizable overhangs of supply, fragile refinery margins, and slower buying from key markets Europe and China. And China is well known to stockpile key commodities. So whether that's copper, aluminum, oil, they just continually, it seems like, build new strategic petroleum reserves. I think they built one a couple months ago, another one. So China does stockpile commodities, but then when China either takes a break or stops stockpiling commodities, then the commodity price could crash. It's happened a lot over the last 10 years. Both Nigeria and Angola still had numerous August cargoes for sale when they unveiled their September loading programs last week. Dated Brent, the spot Brent price with a loading date, is trading at par with the front-month futures contract, down from a slight premium. The weaker Brent price is also reflected in the small 50-cent premium for Brent over Dubai in the Brent to Dubai exchange of futures for swaps, which is a more typical market, would show a $2.50 Brent premium. Okay, that's it for this short little article. If you want to read it on your own, there's a couple charts in here. This is a free article that Energy Intelligence put out on Monday, July 27th. Oil price pattern sees rising selling pressure. The article will be below the video after the show is over in the information and description section. Recently, one of my favorite oil journalists, Nick Cunningham, he does a really great job at oilprice.com, which is one of the best free resources. Also, if you want to track gasoline demand here in the U.S., there's a new website that Shy Girl Tracy Schuchart was promoting, Gas Buddy, so they track gasoline demand trends. But there's also a Forbes article I have out here from 2 weeks ago saying U.S. demand for gasoline is still well below its pre-global pandemic levels. So why oil remains stuck at $40 by Nick Cunningham from July 29th. Oil prices posted gains once again on Wednesday on the back of bullish data from the EIA, Energy Information Agency, but analysts are warning that plenty of downside risks remain. So the probability of the oil price falling is quite high, and a lot of it is based on, I would say, not just demand, but also how many people are getting infected and the politicians and bureaucrats and central planners trying to impose more restrictions on the economy. So the more people that the politicians claim are sick, the more restrictions that the politicians and the bureaucrats put on the economy, the less likely the amount of the demand for oil and gasoline and jet fuel is going to increase. And if it does roll over, if demand, which was rallying from a couple months ago, and yes, it's still low compared to what it was before the pandemic, but it has rallied a pretty decent amount. But if it rolls over again, if demand rolls over again, you could see another crash in the oil market. And you're already starting to see more oil service firms and drillers declare bankruptcy in the last 10 days. You've had oil firm BJ Services file for Chapter 11 bankruptcy. I'm not going to read that story. I'll put the story from Reuters in the information and description section. That story was from July 20th. The other story is another Permian oil producer files for bankruptcy from July 27th by Charles Kennedy, and that one is Permian oil producer Rose Hill Resources. So let me get back to the $40, why oil remains stuck at $40. Okay, the EIA reported a huge drawdown in crude oil inventories on Wednesday with a drop of 10.6 million barrels. That was enough to lift crude oil prices a little bit, but several analysts argued this week that the bigger picture is murkier, with economic and pandemic-related risks looming. Quote, while, and especially in China, if you've seen a lot of the coverage from China in Focus or NTD or Joshua Phillip or China Uncensored, there is a lot of natural disasters and problems with dams and flooding and earthquakes, and also a new second rounds of pandemic all over China. I mean, Joshua Phillip is documenting this on his YouTube channel, excellent YouTube channel. He's an excellent journalist, about like how a lot of the main Chinese Communist Party elites have not been seen in the major cities in weeks. So they're staying away. They've ducked out of the cities, and that's because, according to the stuff that they're showing on China in Focus and Joshua Phillip on their news coverage of China, that there's more global pandemic outbreaks back in China that the Chinese government is not controlling and lying about and covering up. So China is dealing with a lot, and China is one of the main demand drivers for oil and gasoline. Okay, risk looming, pandemic-related risk looming. Quote, while upward momentum has stalled over the past month, we still think prices are overdue for a downward correction to reflect the flattening of oil demand recovery and the darkening of economic prospects. Standard Chartered analysts wrote in a note. The investment bank added that, quote, consensus views on the oil market balances in the second half of the year have, quote, weakened significantly over the past month. We're now we now only rarely hear talk of V-shaped oil demand recoveries and extremely tight markets, the views that allowed Brent crude to rally beyond $40 a barrel, Standard Chartered said. Instead, the main talk among traders seems to have shifted to precisely how much demand will disappoint and how long will it take to normalize inventories. So this is not, if that is the expectations in the market, a surprise to the upside, a surprise in demand level, or a drop in inventory would move the oil price higher. However, it seems that a lot of people are expecting the opposite. Now, it is not guaranteed the oil price will crash, and we're in a world where there's constantly changing rules. There's a lot of manipulation in markets. There's a lot of paper oil futures contracts too. So it's really weird to see the oil price basically in a really tight trading range for the last 4 to 6 weeks. So the odds in terms of probability, the odds of this continuing where the oil price stays around $40 a barrel for another 4 weeks or another 6 weeks or another 8 weeks or another 10 weeks or 12 weeks, probably pretty low. So I think the probability, as we see more and more news stories, more and more economic data points, that the U.S. economy, that a lot of small businesses are closing, and the amount of unemployment is starting to increase again. I think the last 2 weeks, the amount of Americans that filed for jobless claims has started to spike again. So as we see these types of bearish economic data points, I mean, the less, normally anyway, because a lot of people don't have savings unless they're getting paid an extra $600 a week for their unemployment benefits. But normally when people don't have jobs, they tend to not drive nearly as much. Then you also have the auto sales data here in the US. The auto sales data in Q2, I think that came out in the last month. It was down over 30%. And summer driving season, the data on that just does not look that good. So normally for oil and gasoline demand here in the US, if it's a lot of the demand is from summer driving season, and the summer driving season numbers are not good. So the rest of the year is normally nowhere near the levels of summer driving season. Now maybe things will change, will be different than normal because of the pandemic, and there's some type of recovery later in the year or next year. But normally the summer driving season is by far the largest amount of gasoline usage here in the US, because a lot of families or college kids get in cars and drive somewhere for a mini vacation, a short vacation, instead of flying. I mean, people also fly, but a lot of people also drive, especially if gasoline prices are cheaper. So again, if you want to monitor gasoline demand, you can go to the website gasbuddy.com. I think GasBuddy has a weekly now for free gasoline demand update. Okay, the investment bank added that consensus views on the oil market balances in the second half of the year have weakened significantly over the past month. We now only rarely hear talk of V-shaped recovery, demand recoveries, extremely tight markets. The views that Brent, normalized, I already read that. That assessment stands in stark contrast to the behavior of crude prices in the last 6 weeks. Volatility has vanished, which is really rare for volatility to vanish this much, considering how many papers futures contracts there are to actual barrels of physical crude oil. There's a lot more paper barrels than there is physical crude oil barrels. I think it's at least 5 to 1. Volatility has vanished, with WTI remaining rooted at about $40 a barrel and Brent crude a few dollars more. Prices have been stuck at those levels even as the optimism surrounding economic reopenings has dissipated. The only sign of a more pessimistic outlook creeping into oil markets is a shift from backwardation towards contango. As Standard Chartered points out, the discount for front-month Brent contracts relative to fourth month Brent contracts has widened over the course of July. Quote, in our view, Brent above $40 a barrel seems increasingly discordant with the flow of news regarding the global pandemic and the outlook for the global economy, and particularly jars with increasingly bearish oil market fundamentals, Standard Chartered analyst concluded. And yes, I did miss the rally in a lot of these oil stocks, but I didn't think the rally would be nearly as strong. It went up a lot quicker than I expected it to. I thought maybe the oil price would rally back to, after it crashed and went negative, it would rally back to a trading range maybe between 20 and 35 and be very volatile. And instead it rallied very sharply, probably on short covering. My educated guess, there was so much shorts, so many people piling on shorts, that those shorts covered, and that fueled the upward movement in the rally. And we've had a rally faster than I expected in the oil price, where it's gotten back to 40, whereas I expected a trading range for a while for between 20 and 35, very volatile too. And we haven't had that volatility. So this is very interesting that we haven't had the volatility for a while now. It's over 4 weeks. It's about 6 weeks. Very little volatility for the oil market. Very, very unusual too. Again, considering the amount of papers, futures, contracts in the oil market relative to the amount of actual physical barrels of oil. In our view, Brent crude above 40 seems increased. Okay, however, on the flip side, U.S. gasoline demand jumped in the latest EIA Energy Information Agency data through July 24th, rising to 8 So gasoline demand did jump, rising to 8.8 million barrels per day, ending several weeks of decline, at least temporarily. That level of consumption is the highest in 4 months. Also, I forgot to bring up the point about the actual oil stocks, so I'm not in a hurry to add any oil stocks. So some of my Patreon account contributors are sending me messages. They want to know my best small oil company picks. And if you want ideas for that, you should go listen to the Dan Steffens interview I did in the last couple weeks. He's out of Houston, Texas area, and he covers the tinier, smaller, and mid-cap oil companies in the U.S. full time. So he does an extensive amount of valuation and research and analysis, works as industry contacts. If you're looking for small oil companies, if you're actually bullish oil in this environment, and I'm really worried about the demand side now. If the dollar gets weak enough and miraculously there's some type of vaccine, and I'm not optimistic that that's going to happen anytime soon. So I'm not in a hurry to go out and load up on oil stocks right now. There was a nice rally in oil stocks after oil prices went negative. As Tavi Costa said, the oil stocks actually, when oil prices went negative for the front month futures contract, the oil stocks actually rose. So there was a lot of smart money that was accumulating oil stocks then, seeing the rally was going to happen. But it looks like all the easy money on the oil rally has been made, and now there's significant. Now, obviously, nothing's guaranteed anymore except for currency devaluation and taxes, and politicians changing the rules. Politicians and bureaucrats and central bankers changing the rules. But there is a high probability of a lot more downside, again, in the oil market, especially if the global economy has a lot more problems. Okay, the oil market demand, the gasoline demand jumped in the last EIA data through July 24th, rising to 8.8 million barrels per day, ending several weeks of decline, at least temporarily. That level of consumption is the highest in 4 months. Moreover, the surge in cases in the United States has eased ever so slightly, with key states such as Texas, Florida, and California seeing infections coming down from recent peaks. Actually, it looks like that data is starting to reverse in a lot of those states. Starting to go up again. This could be a sign of retreating demand risk from possible slowdowns or targeted lockdowns, but the prospect of a second wave later in the year still presents looming risks. Clearview Energy Partners wrote in a note to clients, the second wave in the U.S. may be plateauing for the time being, and the rebound in gasoline demand combined with the drawdown in inventories boosted oil prices midweek, but the sentiment shifts from week to week, and it is not clear that the prevailing wisdom that oil markets would be in a substantial supply-demand deficit in the second half of the year will pan out. On Tuesday, Rystad Energy, which is a oil research firm, warned that the loosening of the OPEC Plus production cuts could lead to a renewed surplus for the next 4 months. Global supply is expected to increase rather significantly over the next several months because now that we're at $40, the lower-cost U.S. shale oil producers want to start bringing on wells again because they need the cash flow. Again, this is a global cash flow problem, and oil companies, yes, a lot of them shut in wells and cut production, but now that the oil price has rallied a little bit, they need that cash flow back. Global supply is expected to increase rather significantly over the next several months, outpacing expected demand increases. OPEC's experiment to increase production from August could backfire as we are still nowhere near out of the woods yet in terms of oil demand. The overall liquids market will flip back into a mini supply glut, and a swing into deficit will not happen again until December 2020. Bjorn Tonghaugen, Rystad Energy's head of oil market research, said in a statement on Tuesday. On Wednesday, Tonghaugen stuck with that thesis despite the price increase on the back of the Energy Information Agency data. Rystad pointed to the unexpected rise in infections in Europe, a negative development that has yet to be factored into market expectations. In fact, data from Europe shows a decline in road traffic as virus cases rise. Quote, don't be fooled by today's price gains. They may be canceled as soon as production exceeds demand, which is around the corner, and as this is expected to last for some time, traders will race to price it in, Tung Howen said. I have two more articles here. Let's hear Shell CEO. This is from July 16th. The Royal Dutch Shell CEO says, don't expect a V-shaped oil demand recovery. The global economy and oil demand are most likely not headed for a V-shaped recovery, as the global pandemic will have a knock-on energy demand for years. Royal Dutch Shell's chief executive Ben van Beurden told IHS Markit vice chairman Daniel Jurgen in an interview, quote, it's most likely not going to be a V-shaped recovery. While gasoline demand is recovering due to increased use of personal transport, energy demand and some of the demand for mobility will continue to be lower, even when the virus is behind us, Shell's top executive noted. Quote, but in general, because a lot of people probably don't have jobs and a lot of people are working from home. But in general, energy demand and certainly or don't have their small businesses anymore. And certainly mobility demand will be lower even when this crisis more or less is behind us. What it will mean that, will it mean that it will never recover? It's probably too early to say, but it will have a permanent knock for years. Shell's CEO said on the Q1 earnings conference call at the end of April that the current crisis is a crisis of uncertainty, and we don't know what's on the other side of it, and they slashed their dividend. I think it was smart for them to cut their dividend, because I was predicting that British Petroleum, or BP, about 3 or 4 months ago would cut their dividend. I was looking at their Q1 financials when they announced, and I did an article on this for my Patreon account contributors months ago, and their financials looked, their balance sheet and income statement of cash flows looked really ugly. And it looks like BP is going to be cutting their dividend. I haven't checked in the last week or so to see if they cut it already, but it looks like they're going to. We're looking at a major demand destruction that we don't even know that will come back. So the oil price may come back, but if the volumes are significantly lower, we still have a major dislocation, of course, in our own cash wheel. BP's chief executive, Bernard Looney, is not ruling out either that the oil demand crash and perhaps the subsequent lasting change in people's lifestyle may have already brought about peak oil demand. At the height, that doesn't mean the oil price can't still rise, though. If the dollar is devalued enough or supply, very little investment is made into new oil supply, because only the U.S. shale oil companies for the last 6 or 7 years were getting the capex that they needed. They're actually getting too much capex and still losing money. It was subsidized by the U.S. government and the Federal Reserve and Wall Street. Shale was subsidized. It's meant to be a loser to give the U.S. energy security. At the height of the lockdowns around the world, Shell announced in April its ambition to become a... Okay, I'll just skip that part, because that doesn't have to do with oil supply demand fundamentals. Okay, last story here. Rystad's new oil demand. This is from July 25th by Julianne Geiger on oilprice.com. Again, probably the best free website for free oil, natural gas, energy market research. Rystad's new oil demand scenario banks on second wave of the global pandemic. Rystad Energy is now changing its base case scenario for oil demand, banking on a second wave of the global pandemic. The new assumption for the base case now incorporates a mild second wave of the global pandemic, which will stall the global oil demand recovery. While Europe reopens parts of its economy, triggering an increase in oil demand, increases in the number of global pandemic cases in other large oil consumers, including the United States, Brazil, and India, will offset those European increases, according to Rystad. Rystad also added a worst-case scenario, one that sees oil demand to be 3.7 million barrels per day lower for the remainder of 2020 compared to the above base case scenario, if full lockdowns are re-implemented globally due to increases in the global pandemic. Rystad notes, however, that even in this case, where a second wave causes widespread full lockdowns, and a lot of it is politically oriented too, so people should be responsible for protecting themselves, not politicians and bureaucrats implementing stuff, especially Dr. Fauci there, who doesn't even wear masks at the baseball game. Just ridiculous. These guys are hypocrites. Drunk with power, horrible track records. Hypocrites. Oil demand will not be as hampered as it was back in April when the virus first shocked the oil markets. This, Rystad suggests, is because the world is now armed with better information with which it could implement more targeted lockdowns and handle increased infections. Yeah, but that would hurt the economy even more, which would also hurt oil demand. So even if they're better able to deal with the virus, they're still hurting the economy. This is still intervention that's hurting the economy, as Dr. Ron Paul said in the excellent interview with George Gammon recently. Also at play is the fact that the economy simply cannot handle another economic meltdown. Thank you, Captain Obvious. Rystad now sees its base case calling for oil demand to stay flat through October before inching slowly up thereafter, but more slowly than Rystad had previously predicted. For July, Rystad now expects oil demand to average 90.2 million barrels per day, 90.6 million barrels per day in August, September, and October, 93 million barrels per day in November, 94.7 million barrels per day in December. So they're predicting a recovery by November and December. This compares to oil demand of more than 99 million barrels per day last year, so it's still down pretty significantly. But Rystad's predictions don't just have oil demand snapping back immediately after 2020 either. According to Rystad, this second global pandemic wave will last through February 2021. Annualized, Rystad now sees full year 2020 oil demand averaging 89.7 million barrels per day, with 2021 oil, so that would be almost 10 million barrels per day below the 2019 numbers, which were, this compares oil demand of more than 99 million barrels per day last year in 2019. So they're projecting averaging 89.7 million for 2020, with 2021 oil demand averaging 97.1 million barrels per day, still under the 2019 average. In fact, Rystad does not see oil demand snapping back until the end of 2022, when it sees aviation activity as fully recovered. So jet fuel. Auto sales, the auto sales data I've seen, especially in the US, is abysmal. It is abysmal. I don't know why anyone would go out and buy a car right now, especially if you wait for Congress, and Congress might start subsidizing and giving away free cars. Coming up with a new type of bailout scheme, maybe even more ridiculous than cash for clunkers. I don't know who's going to buy a new car in this environment. The used car sales numbers are horrible too. I looked at those in the last couple days as well. Okay, I have some super chats. Let me take a look at those. Don't forget to click, tap, or smash the like button if you like the content. Also, if you want to check out my Patreon account, there is over 100 pieces of articles, audio podcasts, technical analysis charts behind the paywall for only $5 a month, which is the cost of a overpriced, mediocre cup of coffee. There are a lot of articles there about royalty and streaming companies, oil companies over the last 4 or 5 months. I haven't done that many oil updates in the last couple of months. I've been waiting to see the Q2 earnings, and also I've been suspecting that there might be a rollover here. I'm not in a hurry to go and buy a bunch of oil stocks right now, given what I'm seeing in the real economy, the problems in the Chinese economy with natural disasters, and the global pandemic, the amount of reinfections there, the amount of outbreaks again. Okay, super chat from Jonathan. Thank you for the super chat. He is also one of over 1,000 Patreon account contributors. What do you think about oil tanker stocks? Most of them are at an all-time low. So I was debating interviewing Cuppy about this. Cuppy is, I think, the first person who was big into the oil tanker trade, the super contango oil tanker trade. And he is still adamant that they can lock in the free cash flow. And a lot of other people are adamant that he's wrong. So I've seen a number of articles over the last 6 weeks that the oil tanker lease rates for oil tankers have collapsed by well over 20%, the lease rates. But Cuppy has said that the oil tanker companies already locked in the lease rates. So it's kind of, I would have to spend more research on this. This is probably something I'd have to do, like balancing it out and presenting both sides of the argument, maybe in an article for my Patreon account contributors. So it's not something I'm going to do on a live stream show for $5. I think it's complicated. I think there could be maybe another pop, especially if demand collapses and then there's a rush to maybe store the oil. But so far it looks like I was right when I was arguing with some of my Patreon account contributors who were adamant that the oil tanker trade would last a long time. And I said it was just a trade. And I think it lasted maybe 60 days. Approximately, it lasted 60 days before the lease rate started to collapse. And then the people that were long a lot of these oil tanker stocks started to really get worried. So In hindsight, I think it was, for now, I think it was just a short-term trade, but we'll see. We could have another pop, but in general, these oil tanker companies are not good businesses. So even though the oil tanker companies had like record high lease rates and demand for them, some of these oil tanker company balance sheets still did not get fixed that well. $20 super chat from Daniel Ashley. Thank you for the super chat. Much appreciated. He says to upvote the video. That would be nice. Be nice if I got to 40,000 YouTube channel subscribers quickly. So thank you for the super chat, Daniel. I appreciate it. Super chat from JB Weld. Thank you for this $10 super chat. Appreciate your work, Jason. If inflation takes off, do you think the Fed will pull a Paul Volcker and let interest rates take off to arrest it? Okay, so the Fed can't pull a Paul Volcker this time because of how leveraged the economy is. It would collapse everything. The Fed cannot, they're going to let inflation run hot. Stagflate and tax and lie. They cannot raise interest rates. Everything is way too financialized, way too leveraged. You have a leverage short volatility trade. If the Fed raises interest rates significantly, more than just like a quarter point. Let's say they attempted to do something, I don't know, maybe they raised 2% or something, which would be a lot. Everything is so leveraged. So you have a massive amount on this leverage short volatility trade. If there's a lot more, this is why the Fed's trying to manipulate volatility, trying to knock it back down. Everything is way too leveraged. The financialization of the economy, the leverage short vol trade, the risk parity trade, the basis trade, all these trades that are being set up by all these entities that are pretending to be hedge funds, the pension funds, university endowments, even central banks. When you have that much leverage in the system, you can't raise rates that much. It'll collapse everything. So they're gonna do stagflate. The scenario that they want is stagflate and tax and lie, where they let inflation run hot, pretend that there's no inflation, scream to everyone that there is deflation while everyone's bills go up, and then politicians at the state and local level here in the U.S. will raise taxes when they shouldn't raise taxes. They should be cutting back on the size of government, but that's not what politicians and central planners and bureaucrats do. They don't do prudent things like that. They just see if there's a problem, their solution is always just raise taxes or create new taxes or layer on old or either raise existing taxes or layer on new taxes. So I don't think there's any Paul Volckers out there. The system is way too leveraged. It's a Ponzi scheme. For all intents and purposes, the current global financial system with fiat currency and credit is a Ponzi scheme because it mathematically cannot be paid off. And so new debt at cheaper interest rates must be used to either cancel out or roll over or be issued to deal with the old debt that was higher interest rates. So the system is currently set up as a Ponzi scheme. And you can't raise interest rates significantly on a Ponzi scheme. The system was not a Ponzi scheme when Paul Volcker was there. There was not hundreds of trillions of dollars in derivatives. There was not pension funds and university endowments leveraging up their balance sheet like crazy, and all these guys doing the leverage short volatility trade, all these entities doing the leverage short volatility trade where a 5% drop in asset prices could potentially wipe out major players, and the Fed would have to go in and bail out a bunch of different long-term capital managements. Super chat from Bob. Thank you for the super chat. Thank you for the $5. I appreciate it. The Fed's going to let inflation run hot. Now, they don't want the dollar falling too quickly, but we'll see what type of control mechanisms they have. That's my view. That's my view on things, my opinion. So stagflate and tax and lie is where the Fed screams about the people on financial TV, and the Federal Reserve screams about deflation. Oh, we're not going to even think about raising interest rates. But meanwhile, your bills, all your everyday stuff, and your taxes, your bills and your taxes are going up. Super chat from Anthony for $5. Thank you, Anthony, for the $5. He says he loves my Patreon. The loose change in short supply, how are we? With loose change in short supply, how far away are we from the dreaded Fed coin? The Federal Reserve, all these major governments are all moving things along towards government crypto. I think China's ahead of everyone else because China's already testing crypto yuan with their version of Uber, their taxi service or rideshare. I think it's called Didi, and then also their grocery store delivery. So the other governments are moving it along. They're just a couple years at least behind China. Super chat from Eric for $5. Thank you for the super chat. My thoughts on photo companies like Kodak getting billions for vaccine products, i.e. Fuji and Kodak, seems a little fishy. Kodak was a silver hedger, silver bailout. It's just a culture of corruption. The average American does not understand the magnitude of waste, fraud, corruption, and abuse here in the DC metro area. For the federal government, all the government agencies, they don't understand the waste from the Pentagon. They don't understand the Medicare, Medicaid, Social Security fraud waste. So when the PPP program, the Paycheck Protection Program, or the SBA loan program that's supposedly a loan grant and the grants are forgiven, it was very predictable because I'm well aware of all the big government screw-ups here with corruption, unbidden contracts, federal government employees getting away with felonies, and the mainstream and stealing, and the mainstream media doesn't care unless Trump is in the White House. That's like the only time they care. They didn't care about that at any time prior. It's almost as if like the mainstream media is pretending that there was no corruption at all here in the Washington D.C. metro area and waste prior to 2016. So I'm not surprised at all that there was some type of scheme bailout with insider share purchasing, knowing that he was going to get all this, a $765 million loan that can be forgiven from the federal grant or loan or something. But the amount of waste in the PPP program, the fraud and the waste, that was very predictable. Most Americans are not even aware of this, about the amount of Medicare, Medicaid, and Social Security fraud. It's tens of billions of dollars per year in Medicare, Medicaid, and Social Security fraud. That's per year for decades. That's how wasteful things are. It's big and bloated. Big government is bad. It wastes tons of currency units. And if the dollar didn't have the world reserve currency, I don't think that they could get away with it. There would still be government corruption because that's the nature of government, but nowhere near the scale that we have now. And they get to paper it over. So the waste, fraud, corruption, and abuse, the Federal Reserve and the Fed just gets to paper over a lot of it. So there are, here in the DC metro area, the demand for real estate is enormous. There are tons of people moving here willing to pay higher and higher real estate prices. And it's based on the assumption that the federal government will not have to cut its budget. So whether Biden wins or Trump gets a second term, the assumption is that the federal government here in the DC metro area will not have to cut back at all. And the budget may even increase, and the size of government here in this area may grow. And that's good for DC metro area real estate. Okay, last super chat here before I wrap things up. I'm kind of getting tired. Let's see here. How long have I been going for? 43 minutes. Okay. Thank you for the $5 super chat, Abbey Road. He is also a Patreon account contributor. My oil stocks are down 8%. Again, you were the one who emailed me telling me that you bought the oil stocks. I've been very skeptical about the oil rally. I thought more rationally that the oil price should have bounced around in a very wide and volatile trading range after the oil prices went negative from about $35 a barrel down to 20, and then back and forth, yo-yo, back and forth, back and forth, back and forth, and we haven't had that. So I think the probability is high that we might end up doing a trading range like that in the near future. The main part to worry about in the oil market is still the demand side. Your oil stocks are down 8%. Can you make a wild guess of the prospects going forward 1, 2, and 5 years? Educated guess is in the short term, probably over the next 6 to 12 months, oil is going to be extremely volatile. So we had our big crash in oil in February, March, April, I think, and then maybe part of May. We had our big rally in May and June. End of April, I think May and June. Oil's been shockingly calm for the last 4 to 6 weeks. The odds of oil remaining calm and flat in a oil market where there's lots of paper futures contracts, which means a lot more hedge fund traders setting up leverage trades with a lot more normally volatility, the odds of oil staying flat for that much longer, I would say very, very low in my opinion. So my educated guess is, depending upon what happens with the dollar, the oil supply demand fundamentals, I would say the demand part is looking weaker over the last month or two, with more global pandemic cases, problems in the Chinese economy that we're seeing on China in Focus with the flooding and the natural disasters. That doesn't really look bullish oil demand and gasoline demand for me. China did a lot of stockpiling over the last couple months. And normally China, after they do a lot of stockpiling and drive up the commodity price, they take a break. And what happens when China takes a break from stockpiling a commodity? Normally the commodity has a pretty big correction or crashes. And then China decides if it wants to stockpile again. So short term, I would say there's going to be a lot more volatility in oil. The higher probability is that it will probably have another correction, especially what I'm seeing with demand and problems in China. And then after that, there may be another buying opportunity. So I did not tell you to go and buy those oil stocks. You thought that the bottom was in. That was not my fault on that one. I was expecting, like I said, I was wrong about how large the oil rally would be. I got that wrong. And I thought there would be a lot more volatility after oil bottomed. And we haven't had the volatility yet. So I suspect that over the next 6 to 12 months, there will be a lot more volatility in the oil price coming back. And there will probably be one more bottom bounce. I don't know about negative or anything like that. Maybe oil just goes down to 20. Maybe oil goes down to 20. There's one more flush out. We're seeing a lot more signs that oil companies are still, some of the drillers and oil service companies have had to discount too much. Either they're not getting business or they had to discount too much to get any business, so they destroyed their margins. And I think the tankers might just be, if the tankers do have another pop, it might just be another trade, another short-term trade. Look, Cuppy is a really smart guy. I've read his tweet threads on the oil tanker analysis, but there's stuff that can go wrong in there. His rationale for that trade for long oil tanker stocks for a long period of time is really good, but things don't always go as planned. So we'll see what happens. Someone says if we have World War III with the U.S. and China, oil will go to 200. Maybe, but then the demand side could collapse again. You got to remember, if oil goes to 120, 150, or 200 a barrel for a prolonged period of time, it then starts, the renewables start becoming very economic again, and then they can start to raise a lot more capital, and you're going to start to see all these headlines about biofuels and ExxonMobil's algae company, which was not, I think they wrote off hundreds of millions of dollars on their algae company investments, their algae biofuels. So those projects start to become economic again. Now, it doesn't happen right away, but for those of us who have been in the energy markets at a long time, if oil gets to a high enough price again, all those renewables start to get funding. Okay, well, that's it for this short little live stream show. I'm going to end it now before my memory starts to get dicey, because I've been talking for almost 50 minutes. Thank you, everyone, for listening. Thank you very much to my over 1,000 Patreon account contributors. There is a lot of great content behind the paywall. I think I charge cheaper than almost anyone else for the quality of the research that's behind the paywall. And thank you very much to my monthly PayPal contributors. Still a few of you, although most of you have gone to Patreon. I don't blame you, because there's a lot more value behind the paywall on Patreon. And people who tip me cryptocurrency. I do take one-time tips for cryptocurrency too. Oh, and one last thing. I did have an interview done with James Grant of Grant's Interest Rate Observer. I recorded it on Monday afternoon. Unfortunately, it looks like Zoom ate the audio. So I'm working with Zoom tech support to get back the 50-minute recording. Hopefully I can get that done in the next couple of days. I'll get the audio back. They said they have it on their backup server, so hopefully I'll get that. And there's some really great insights in there about financial repression, about what the U.S. government did with manipulating the U.S. Treasury market after World War II. There's a nominal returns versus real returns in the bond market. And also if bond vigilantes are dead or bought off and paid for, bribed. So hopefully I will not have to redo that interview, and hopefully I will get the audio. I did record the audio, and then then Zoom screwed it up. So hopefully I will get that back soon.